assessing the sell-off that we saw?
Hey, Haslinda. I think this was in a way overdue because I think the mid caps and the small caps had run up a fair bit, with almost 50% of them trading over 40x speed. And I think the only thing which held off the sell-off previously was just a strong macro, which has prevented a sharp sell-off. But I think this is a normal correction and just brings back the large caps and small caps to a similar range. I think they had run up a bit more than what the fundamentals required them to. So I think it's a healthy correction in that sense.
Right, but the correction is also driven by the clamp down we've seen from SEBI. Is that clamp down justified? Should it be expanded or not?
So I think it's more of action to protect a whole set of new investors who have come in. So I think it's more from the perspective of protecting the new investors, plus ensuring that it doesn't create a ripple effect onto the broader markets as well. So I think it's more a proactive step that SEBI had done. And I think that was just a trigger that was required. Otherwise, the macro was preventing a major sell-off. And this was just a trigger for the correction that was anyway due to happen.
Are you looking at possible opportunities? What are you advising clients to do? Should they be looking at smaller private plays in terms of banks? What are you looking at in terms of opportunities?
We think the large caps is where things look most attractive. I think we've held that view since start of the year that the larger names, especially in the banking sector, are looking a lot more attractive versus the smaller names. I think large cap banks, especially the large 3-4 private sector banks, is really where we would advise private, investors to be at this point in time.
And in terms of shadow lenders, are they an attractive investment? Recently, we've seen how SEBI clamped down on shadow banking. There are concerns in that particular sector.
I think there again, the concern from the regulator, both RBI and others, is around the new type of lending models that have emerged. An abnormal pace of growth in certain segments is what is coming under scanner. I think at an aggregate level, the credit growth has been fairly healthy in the sector. We are not concerned either the overall credit or even within consumer. I think at an aggregate level, we're still in a very, very healthy pace of growth, nothing excessive that we see. The clampdown, we think, is more a preemptive step to make sure that the due processes are being followed. There is no risky segments that are being onboarded. I don't see that as any indicator of the overall consumer lending segment in the country. So I think we remain positive on the consumers lending segments as well. But for NBFCs that have seen much faster than usual growth, I think there's probably some amount of a slowdown which is going to kick in as we go forward.
Might credit growth slow down or moderate given regulatory actions recently? Is that something we might expect?
Yes, on the consumer side, I think we definitely are expecting a slowdown in growth. I think that part has been communicated by the regulator, and also the actions being taken are driving the banks and NBFCs towards that. Right? So both the increase in risk weight, the clampdown on certain types of loans which were seen as unhealthy or growing too fast, will all result in a slowdown in consumer credit. So I think that is something that's already priced in. I think the overall banking credit also is probably a couple of percentage points higher than what most would have expected a year ago. And that has been largely led by consumer growth. I think that will moderate, but hopefully the commercial credit or the corporate credit will pick up, especially the capex cycle kicking in, to keep the overall credit growth still in that mid-teens range for the banking sector, banking as well as the NBFC sector.
You're saying that it is time to get back into India's private banks versus public banks. Within that sector, which ones would offer the best value?
To us, within the private sector banks, we like HDFC at this point in time, just given that the core of the franchise remains intact in terms of its deposit gathering ability, plus its stellar underwriting track record, coupled with valuations that are extremely attractive. HDFC remains a top pick. And I think there's a broader call for us, from us to shift from the public to the private sector banks. I think most, all the 3 or 4 large private sector banks look attractive at this point in time. given that there is the overall healthy credit growth plus reasonably benign operating environment, we think that the large private sector banks look attractive. Within that, HDFC is our top pick.
Before we let you go, Pranav, the big question in India right now is when the RBI will start cutting rates. I mean, what's your own assumption?
See, our assumption is we'll have a shallow rate cut somewhere towards the later part of this year, after the elections, maybe somewhere in the September to December period. But it should be a shallow rate cuts, 25 basis points, which will not have a major impact on the banking margins.